Hey everyone, I am sharing my value add hotel valuation model that I built in a real estate finance course at Cornell. And I thought I'd kind of walk through how the model is built so that if you have your own value add opportunities that this model might give you some ideas. There's definitely some modules here that can be of use to you. Now this isn't necessarily a model that is chug and plug ready, but it's definitely fully dynamic. It's built for a certain case that I was working on. Nonetheless, I think it does have some usefulness for other type of projects. So I'll walk through how it's built and how you might be able to use it with your own projects. Now this is multi-scenario. So what that means, and if you come here to cell J3, you purchase a hotel. It needs either rebranding or repositioning in some way, and you want to test different scenarios, right? So rather than creating multiple tabs for each scenario, making your model overly cumbersome, I use a simple tool here where with a drop-down menu and a simple scenario table, we're able to limit this particular model to just 3 main tabs, and I have a graph tab as well that kind of illustrates the outcomes. But ultimately, it looks simple because of this scenario model. So again, how it works here, we have the scenario. We drop down. I had, in this particular case, 3 scenarios. We looked at an independent, keeping the hotel independently branded, bringing in third-party management. We also looked at the possibility of branding the hotel with our own management, and then finally branding the hotel and bringing in third-party management. You can add scenarios. You'll have to have some understanding, hopefully, some advanced understanding in Excel in order to add scenarios, but you can definitely add scenarios. You can change naming of these scenarios. In this particular model, as with most models that you'll see that I do, any cell with blue font are cells that are static that need to be changed, and when you make changes in those cells, it flows through the rest of the model. And so we have here our scenarios, and these scenarios are linked to this right here. So we come in and right now I'm calling scenario 1 independent. I could call this independent plus third party management, and up here it changes and now it's called independent plus third party management, right? So if you want to change your scenario names, you just do it right here in the scenario table. And then let's move on here. Again, this is the first tab. This is the summary tab. Most of your inputs occur here on this tab. If you wanted to change this model to make it your own, feel free. You'll notice on the second tab, the P&L tab, I do have a few inputs, and that's simply because I didn't make this model as thorough as I could have because I built it for a specific scenario. But here we have under assumptions, right, hotel name, the purchase price in this case, and then within the assumptions it calculates the all-in basis based on over here you see renovation cost for the different scenarios. So right now we've selected the scenario 1, the independent scenario, therefore the basis is this 12 million purchase price plus the 6 million in renovation costs involved with scenario 1. Then we have selling costs. This is when we exit, we're anticipating 2%. Additionally, there's a discount rate. This assumption is included. Then I have rooms. Rooms are important because a lot of our metrics are based on the rooms. And then we have number of days in the year. And that's important when we're looking at the yearly basis, right? Then we come down here to our scenario table. Again, more inputs, more blue font. Again, we can change the names of our scenarios. We can adjust the management fee as a percentage of revenue charged on each one of these scenarios. I also have a year 5 management fee, and the reason I did that was in this case, on my exit, I was actually assuming with the independent and the branded scenarios with inside management that an outside acquirer might want to bring in third-party management, or they might underwrite their management fee to be more in line with market, which is 3%. So I did that to make my terminal value more in line with reality, and so that here is a variable. I also have occupancy penetration. Now, if you're not familiar with what occupancy penetration is essentially how close do we match what the market's doing, right? So if you look over here under assumptions, in year one, the assumption is that the market occupancy is 75%. In year two, it's 80%. In year three, it's 80%. In year four, 78%. In year five, 76%, right? And these are inputs that you can change based on the market of the hotel that you're evaluating. But if we have a 90% occupancy penetration, and market occupancy is 76, then this 76, 90% of that 76 is what we anticipate, and you'll see here what the property occupancy is going to be. So that's our penetration. ADR penetration is the same thing, right? It's we anticipate that if market ADR, market average daily rate, is $100, that this hotel under this scenario its ADR will be $90. Next we have renovation cost. Again, because this is a value add scenario, the idea is we buy the hotel, we spend either 6, 8, or 10 million, depending on this scenario, and bring the hotel back up to market standards, or stabilize it, right? And then we sell that now improved hotel. So these are our renovation costs. The assumption is all these costs, in this particular model, the assumption is that these costs will be paid out over the first year. That'll take 12 months of construction. It's areas like this where for your own model you'll have to make adjustments to this model. If your renovation costs are going to take 2 years, well, you're going to have to go in and make adjustments to the formula in the P&L to account for that. Next we have the incentive. Now the incentive is the incentive paid either to the manager or to the brand or both. Generally it's a percentage above an NOI number, or it's a percentage of NOI above a certain number. And in this case, each one of these scenarios were quite complex in how that incentive was built out. And so the incentive itself is built into the P&L. And so if we go to the P&L tab and we scroll down to row 47 here, it's actually in this group, and I've hidden the group, but if we open the group, I have the different scenarios. I've modeled them out. They're modeled out really by hand, right? So they're still dynamic based on the scenario table and the assumptions in the scenario table from the summary tab. Nonetheless, for your scenarios, for your hotel, you'll need to come in and make those calculations for the different scenarios that you're running. Finally, we have exit cap. The exit cap, again, being the cap rate used when we sell at the end of the 5-year period. We also have furniture, fixtures, and equipment, and this is a reserve. It's 4%, 4%, and 5%. In this scenario, you can change that, but that's a number that every year there's a reserve to replace those furniture, fixtures, and equipment in the hotel. And then finally, we have a cost per occupied room. And this is how we calculate some of the expenses, and you'll see that as we move to the next tab. Again, this is a variable number, so if your room's not occupied, then you're not paying this amount. And then we come back to the assumptions table here. You can input your own market occupancy for each year, what you project. Also, your market ADR today. And then for your first year, year 2 through 5 will auto-calculate based on your ADR growth that you drop down here. Then we have here property occupancy. Now, the reason why these first two cells, our property occupancy in year 1 and 2, are inputs, or because in this case, this model that I built, I assumed 2 years to stabilization. And so because the property is under construction and it's not quite to the point where I think it's going to be hitting these penetration numbers, I've allowed for inputs to adjust those. This is something you can change on your own. If you want it to be market, right, you can just simply take this, copy it over, and it's going to be entirely based on this. But more than likely, you're going to want to have some sort of reduction in property occupancy and property ADR during your redevelopment period, right? And then again, here we have property average daily rate. Then we come down here, there is an ADR growth number in each year. We have a general inflation number, and our expenses are inflated by this percentage. I assume in this case, and you can make this adjustment, that the inflation for year 1 is the inflation for all years. 3 is a pretty safe number to put there. And then in this model here, our scenario 2 had some franchise fees. It was the only scenario that included franchise fees. And so I included it under the assumptions, and it flows over to the P&L, which you'll see in a minute. This, again, is something where you'll have to adjust your scenarios to account for franchise fees, say, in other scenarios that you might have. And then let's move here to the P&L tab. I'll walk you through that. So I start out with a historic number. More than likely, if you're looking at a value add play, you'll also have some historical numbers, and hopefully you'll have more than just 1 year. I just have 1 year, and so I drop these in more for reference than anything else. And then I have a few inputs. Typically, I prefer to keep all of my inputs on one tab, generally on the summaries tab or on an assumptions tab. But in this case, it was cleaner and quicker just to drop my historic numbers in here, and then assume that year 1 is going to match or be close to the historic numbers. So if you can change these numbers here, you got your food and beverage revenue number, you got your other revenue number, then you have your food and beverage expenses and your food and beverage other numbers, and we drop these in here, and then this should flow through to the end. Now, this is something you're going to want to adjust for your hotel scenario. Every hotel is a little bit different, and so this is not something that can be as fully dynamic, say, as say with a multifamily building. So these numbers here, while I have built them in a way where they're dynamic, it's not going to necessarily fit your scenarios, and so you'll need to make those adjustments. And then we have the same with our undistributed expenses. These are numbers that you can adjust on your own, and they'll flow through. Nonetheless, you're probably going to want to come in and make the adjustments here for your particular hotel. And so these revenues and expenses flow on down through to a gross profit number. Then we have our fixed expenses. These, again, are numbers that you'll want to include on your own. And that drops down and finally gives us an NOI before the incentive fee. We have the incentive fee structure, at least in this case, and then I get my bottom line NOI numbers. Keep in mind, in this model, our sales price is based on a year 5 capped NOI. And based on this NOI, we get a valuation and returns. Here we have our DCF, our NOI coming across, those capital improvements that I had mentioned. So $6 million comes from this number right there. That's our renovation cost, right? So that capital improvement flows in year 1. Again, this is something that you can adjust on your own. If you want it to flow in half in year 1, half in year 2, you can do that. Just depending on how you want to underwrite this. Then I have my discount factors for each of the year at this discount rate. Again, this discount rate was brought over from our summaries tab. And from that, we get our present value of cash flows. present value of the capital improvements there, which again, at the end, I do have an NPV value here, but I'm not flowing it out to the summary tab because it wasn't necessary. But you do have it, and it may be something that's interesting to you. Also, I partitioned the IRR on an unlevered basis where we can see what proportion of the IRR comes from the income versus the residual or the sale. And that helps us to see, I mean, really that tells us whether this is an opportunistic versus a core investment. Clearly, this is a value-add investment, right? So a good majority of our IRRs is going to come from the residual. And so in the end, we run our cash flows. Period 0, we're going to have our purchase price. Period 1, we have our NOI less the capital improvement spend in that year, which gives us, that's why year 1 is negative. We get then year 2, 3, 4, 5. Notice 5 is a very big number. That's because it is NOI in year 5 plus the net resale. That gives us then, I've dropped in the free and clear return for each year and an average free and clear return. So this is going to be the average to date. So this average in year 3 is the average of 1, 2, and 3. That gives you an idea of how you're doing on average over that period to that point. And that then spits out our unlevered IRR, almost 14% in this scenario, and our equity multiple. We then also look on a levered basis, this debt service. Now in year 1, I assume in this scenario that there is no debt service in year 1 because we are stabilizing this. We're not able to acquire permanent financing, and so it's assumed that we're 100% equity in year 1, and then the debt rolls in year 2. That again is something that you'll have to adjust. It's built into this row here. And then I show my debt service coverage. It's nice. We don't have any coverage less than 2. I also have a debt yield. This helps me see the risk of the investment. And with that, I have my cash flow after financing, as well as my capital improvements. That flows down as well to the terminal value less the loan balance at the end of year 5, which is this value. Gives us our net cash flow from sale. And then we have our cash flow that rolls down from there, which if you notice year 1 here is a positive number, unlike on an unlevered basis it was negative. And the reason is because at the end of year 1 we do have our loan flowing in, and that makes this number positive. This could be more accurate. This is definitely a back of the envelope or maybe an early look at the deal. You'll probably want to model this out on a monthly basis, and this IRR would be slightly lower because this loan cash flow is coming in at the end of the year while the capital improvements are being spent throughout the year, and so that's going to dilute the IRR just a little bit. Again, we got then our cash on cash return for the year on a levered basis with our average cash on cash return on a levered basis. That gives us our levered IRR just a little over 21% and equity multiple of almost 2. Finally, in this model, I dropped in a few graphs. You may or may not want to use this, but I just show this. It more illustrates what you can do. I show NOI in the 3 different scenarios. I also show property occupancy in the 3 different scenarios. These graphs here use data from the sensitivity analysis that actually it's on the other side. I'm sorry. From here it is right here. This graph data. That's where we're getting these pretty graphs here are coming from this information. This again is dynamic. If you want to build more graphs, you can, but you don't need to do anything. These graphs will auto-update for you. Come back to the summary. The last thing I want to show is the sensitivity analysis. I think this is an important feature to have. Even at the back of the envelope stage, it's nice to know what the sensitivity of the property is to changes in occupancy or average daily rate. And so I drop in here. Notice again, these are input cells. I've manually inputted these cells, these blue ones here, to be what the case is in our table. And then we run different scenarios. So we got occupancy, and then I have a scenario where occupancy maybe is 82.5, or our occupancy penetration is 82.5% rather than 90% or 75%, and so forth. And then the same for ADR penetration. And what this says is, hey, in the scenario where we have an ADR penetration of just 80% and an occupancy penetration of just 75%, this property actually loses money. Whereas, and so this might be our down state of the world, right, or our worst case scenario. Or maybe in our best case scenario, we're able to exceed the market occupancy, and we have a penetration of 105, and maybe we equal the market daily average daily rate. And in that case, and again, this is on an unlevered basis, our IRR is mid-20s, which is pretty healthy for this. And with that, then I run a standard deviation, look at average unlevered returns across all these different scenarios, and we get what we call a return per unit of risk. Considering that we only have 25 scenarios here, I wouldn't put a whole lot of weight into this, but it's a helpful figure when I'm comparing the 3 different scenarios. It's one way to say, hey, which of these scenarios has the highest risk-adjusted returns. And so the more return units per risk that a scenario has, theoretically, the higher its risk-adjusted return is. Finally, you'll notice these are empty. The reason these are empty is because right now we've selected scenario 1. If we select scenario 2, now we'll see scenario 2 here, and so forth. If we select scenario 3, we see scenario 3 right here. I also have dropped in, it's hidden because I haven't used it much, but I've also dropped in a few other, here it is, it's right below, some additional sensitivity analysis, but testing just one variable. So here I'm testing occupancy penetration for this, and so if you want to test just one variable, you definitely can, and that's what I've done here. And if you notice here, I've hidden it so that it keeps this sheet somewhat clean. And so with that being said, you can go ahead, feel free to download this, change it as you will, make it your own. I'm not asking for anything for it. This is my way of giving back. If you have any questions, feel free to let me know, and thank you for your time.